I would really encourage real estate professional status. Like, hey, if you don't need to make that 15, 20,000, go unlock all these tax benefits through real estate professional status.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer, ADP. I'm glad you're here. Now let's dig in. All right, welcome back, Freedom Point Podcast listeners. This is Jeremy Dyer, your host today. Really appreciate you joining the show again. I've got another amazing guest with me today, Brian Boyd. Brian, welcome to the show.
Thanks for having me, Jeremy.
Yeah, absolutely. Looking forward to this conversation. And in full disclosure, Brian, I think you're the first lawyer that I've had on this show, which we're now, I don't know, somewhere around 130, 140 episodes in. So welcome for ringing that bell for us.
Well, thanks. I don't know if that makes me famous or infamous. So we shall see. We shall see.
Yeah, absolutely. Well, I'm definitely looking forward to chopping this up with you. A little bit of a bio on Brian. Brian's a practicing attorney in real estate, tax, and business law. Brian also authored the book, Replace Your Income, A Lawyer's Guide to Finding, Funding, and Managing Real Estate Investments. So Brian, I know that you've been in the real estate space for quite some time now. You've got a background. Would love to hear a little bit more about kind of how you got into the space, your journey, and what you're really focused on today.
Yeah. So my journey, let's start there. So in 2008, I was a transactional tax attorney at a firm here in Nashville. And I'm sure you remember, much like I do, I'm scarred by it. But I remember watching Lehman Brothers employees walk out with their boxes. And Salomon Brothers fell earlier that year. I had friends working in Manhattan, and the calls were just frantic. Like, hey, do y'all have a job? Can I come here? Can I go there? Where am I going? Because the world fell apart for real estate, M&A, and anything transactional. And as a transactional tax attorney, the world just stopped. Like, nobody's doing deals. And then shortly after that, I got my walking papers and I was without a job. And I got to tell you, graduating from all this education, having student loans, it was terrifying. And I ended up doing contract work, reviewing discovery on a computer. It was mind-numbing. But somebody told me, hey, you can go down to the courthouse and they will give you cases for indigent people. I had never been in a courtroom in my life. I was a paper attorney. I did deals. So I ended up going down to the courthouse, and for the next 3 years, that's how I paid my student loans, my rent, took care of my dog, and ended up getting a client through a referral because all these criminal defense attorneys didn't know anything about tax or corporations or corporate law. And all these criminal defense attorneys, they live in neighborhoods and they've got neighbors that have questions, because a lot of people think a lawyer is a lawyer is a lawyer, and we're not. It's kind of like saying a doctor's a doctor's a doctor. We're all different. And so they would ask me questions, and eventually somebody sent me this client that had a usury concern. Now, for those in the audience out there that don't know what usury is, it is an excessive interest rate charged on loaned money, and it's illegal. And here in Tennessee, and I know the state's touching us, the penalties are severe. So I ended up, working this out for this particular client, and he started using me as his contract attorney. I'd read contracts, I'd negotiate them. It was great. And he then introduced me to his other friends, and he was a real estate developer. And I remember sitting in one of those developers' offices one day, and I just started looking at his business plan. And you can see I've got a whiteboard over my shoulder. I live off whiteboards. I just started taking his business model and overlaying tax how to make it more tax efficient. And he's like, how do you know that? I'm like, well, I'm a tax lawyer. Like, yeah, you know me through this, but this is actually my background. This is where I'm most comfortable. And so that client ended up saving $800,000 in taxes that year. And to this day, he's still a client. I took his business model, and this is about 2015, 2016. The market just wasn't going anywhere. I don't know if you recall, but oil was right around $25 a barrel. And I was working nonstop. So I had fully funded my SEP. I had paid for everything, and I just had discretionary money to have. And I was like, well, I really would like to stop working. And so my goal was, well, if I can make money while I sleep, I don't have to come to work on Saturday. So if I can at least make 400, 500 bucks a night, I'm okay. And, I was working way too much. I was probably working 80 hours a week at that point. And it just got to the point where I was out turkey hunting with a client, and he mentioned coin laundries. I don't know if we've ever talked about that on the show, but he installs coin laundries for people, and he himself has three. Well, I started talking to him about, well, what's the depreciation on that equipment? And, how do you make sure it's active to get onto your Schedule C? And, so it's not active versus passive. And so we just talked, and I'm like, that's fascinating. So I liquidated my SEP and I built a coin laundry. I took the penalty. It's a 10% penalty, 10% tax. Took all that. I sold that coin laundry a year later, actually a year and a month later, to somebody for 4 times what I built it for. And it cash flowed the entire time, and I had the depreciation. And I took that and I bought a short-term rental in Gatlinburg, Tennessee. And then my wife saw, oh, I see what you're doing now. I understand, because somebody gave her Rich Dad, Poor Dad. Even though I've got all these degrees and I know what I'm talking about and I do this for a living, she read Rich Dad, Poor Dad. She's like, oh, did you know this? I'm like, yeah, I did. I've been telling you that for years. So we started buying long-term rentals. So we had short-term and then long-term. And then the short-term rental wasn't really performing. It was breaking even, but wasn't performing. So we sold that, and we bought 13 single-family homes in Chattanooga, Tennessee, of which we still have 12. And at one point, we had 33 doors. I think right now we're around 20. But we took my $100,000 SEP liquidation investment, and we've turned that into $6.5 million worth of real estate. Now, it sounds like it happened overnight. It does not happen overnight. Anybody out there listening, real estate is not an overnight adventure. It's just not. And the returns can be incredible, but you have to pay attention to it. So the first year we sold that Airbnb, that short-term rental, bought 13 single-family homes. So we're at 15 single-family homes at that point. Then we started buying in Knoxville. We bought multifamily in Knoxville, and then we had multifamily in Brownsville, and then a lot of 1031s. Now we have 4 short terms and 16 long terms. And appreciation has been great. But in fairness, I want everybody out there to think about this. We sold one property and bought 13 single family homes. What do you think those homes looked like? So we put another $600,000 into those homes. We took them from a rent roll of $10,500 a month to $22,000. So then we did a cross collateralization of that note to extend out the life of the term. And, we are cash positive every month on that portfolio.
Yeah, Brian, that's tremendous. If you don't mind, I'd like to just kind of comment on a couple things, because I think it's really important, for my listening audience to come away from this with a couple things. But, before I do that, really appreciate, hearing your story about how you, finally started practicing what you preach, right? And in addition to that, highlighting the fact that, you can't get rich in real estate overnight. You can over time, But the important thing is you've got to start making those decisions now so that in the future, your future self will thank you, kind of a thing. But I do want to dial in on the tax benefit side.
Yeah.
Again, it's one of the, I tell investors a lot that it's not the tax benefits why I got into real estate investing, but it's what keeps me there. It's one of the things that keeps me investing and compounding those investments. There's a couple of main topics that come up a lot with investors that I'd like for you to unpack. One of them is related to the rep status, the real estate professional status, of which I personally benefit from as a direct result of my wife and her activities that she's involved with. The
Mhm.
other thing that I'd like to talk a little bit more about is kind of the 1031 exchange, otherwise known as the lazy 1031, or at least that's another type of a strategy where you can benefit from passive depreciation loss activity. And then obviously unpack a little bit more about the DST type structure as well, if you don't mind.
Yeah, so let's start with rep status. That falls under Section 469 of the tax code. And that section identifies real estate specifically as a passive endeavor. Now, in order to make that an active endeavor, you have to spend 750 hours a year, and that 750 hours a year has to be more than anything else you do for income. For example, if you work as a W 2 for somebody, the IRS is going to say, oh, well, because you're a W 2 and you're full time, you work between 1,800 and 2,000 hours a year. That is their default status for a full time W 2 employee. So if you were to try to achieve real estate investor status or real estate professional status, you have to work 2001 hours a year. That's not feasible. So what I try to tell people is like, hey, do you have a self-employed spouse or are you self-employed? That way you can backdoor in through the self-employed status. And it's a lot easier to achieve the 750 hours or the active status. Because once you hit that 750 hours, you're considered active, but it still has to be more than everything else you do that year for income.
I think that's the easy part of it, Brian, right? That part
Right.
of it is easy. I think the hard part is well, what are those things that qualify as activities, right? Like, for example, if a spouse doesn't have a W 2 job outside the home and they decide to go get their real estate license, does that count?
Not really. Yeah. And I think a lot of people, that's a misnomer. They're like, oh, do I need to get my real estate license? I'm like, no, absolutely not. It has nothing to do with that. Real estate professional status means you are a professional working within and around real estate, primarily in the management, construction, operations, leasing, the day to day activities of owning real estate. So, for example, I've got a phone here. Let's just call this a house. And everything related to my operations of this house, from leasing it up to calling the bank, to calling the utility companies, to collecting the rent, to depositing the rent, to sending out maintenance people, to having the grass cut, to anything that comes along with owning that piece of property for rent will fall into the bucket of real estate professional status. So it's not being a real estate agent. And I think real estate agents have a leg up on everybody because they're in and around real estate all the time. So they're finding deals faster. They're talking to people on a regular basis, if not daily. So deals are coming across their desk, which is great. But that doesn't make them real estate professional status according to the IRS. Undertaking these endeavors makes you a real estate professional. So the licensure as a real estate salesperson, broker, agent, that's very different than the status itself.
Yeah, let me give you an example, okay? So let's say you have a married couple and you've got one of the spouses is a significant breadwinner,
Mhm.
okay? And the other one is not, right? They might work part-time or maybe it's a full-time job, but it really doesn't create or drive a lot of income for them. What would be the easiest thing for that non-breadwinner spouse to do in order to be able to claim the rep status?
Well, depending on how much money it is and what their needs are, because it's as a typical attorney, I'm just going to say it depends. Um, it does depend on what their needs are. I would otherwise say, hey, if you don't need that income, or if it's just pushing you into another tax bracket, stop. Go out, buy a duplex, buy a quadplex, and manage it, and get your real estate professional status. Get those leased up, get that going, undertake a cost segregation study on the purchase itself, accelerate the depreciation, get your 750 hours a year, take those deductions, put it on your Schedule C, and you will offset your spouse who's making significant money. You'll offset that income. However, I say that not knowing what the income levels are. This is just a hypothetical. There is an alternative, and that is if one spouse is making $150,000 a year, and let's say it's a part-time spouse that's working at the church or something like that, maybe making $15,000 to $20,000 a year, they can then undertake the short-term rental loophole activities. And what do I mean by that? Well, that is Treasury Regulation 1.469-1TE32A. And that only requires 100 hours a year of managing a short-term rental to unlock all these deductions. But that phases out at $150,000 of income. So you have to be mindful of where are you? Do you need to be rep, or do you need to do short-term rental loophole? Now, a lot of people think, and this used to be the case, $150,000 was a lot of money for a family of four. Well, the last few years have taught us that that's not the case. And I would really encourage real estate professional status. Like, hey, if you don't need to make that 15, 20,000, go unlock all these tax benefits through real estate professional status. Build that portfolio, because that property most likely and historically is going to go up in value. Your tenants are going to pay it down. And that difference between the fair market value and what is owed, that delta, that's your equity that you can borrow from and scale and just keep doing it. And I don't know why people are so afraid. I understand the interest rates are high right now, given what they have been. But, we're nowhere near where they were in the late 70s, early 80s. And people were buying real estate back then, too. So it can be done.
So, Brian, in this example that we've kind of gone through with this kind of hypothetical couple, we'll call it, let's say that they also then, in addition to what you've laid out, let's say that they also are limited partner investors in another sponsor or syndication team's deal. Would they be able to use that depreciation loss activity on that passive limited partner investment in order to help offset ordinary income on the breadwinning spouse's earnings?
No, because limited partners are by definition passive.
Yeah.
So I know we weren't planning on talking about this, but active versus passive, these are different buckets, and they're different buckets on your tax return. So passive profits and losses offset passive income. Active profits and losses offset active income. The two don't really merge. In order to make real estate active, you have to work in real estate to move it over the ledger to offset that income. And that's where a lot of people stumble. They think, oh, I'm going to be an LP in this deal. I'll get a K1. It's going to offset my active income. Not at all. Not at all. It's going to stay locked up in that passive bucket until there's a disposition of that asset, and then it gets unlocked. But once there's a disposition of that asset, you have depreciation recapture, you have capital gains. So it may wipe out the benefits of doing that depending on where that asset is in its valuation. So That's an unfortunate thing. That's why my wife and I have talked about joining syndications. I'm like, only as a general partner. I'm not going in as an LP. I need the offset. So if we're putting $1 million into a deal, I want to be a GP on that deal. Because yeah, the money up front isn't as great, but I'm looking at a 5-year, 7-year, 10-year time horizon to really realize the benefits of that investment.
I'm Zach Haptonstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investors. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
I think now would be maybe a good time to talk specifically about how to kind of defer, some of those tax consequences on gains. And I'm thinking about, the 1031 exchange versus the lazy 1031 versus the DST. Can you kind of help unpack a little bit about, what kind of some of those differences are and maybe what makes most sense for investors?
Yeah. So, when I talk to people about, like kind exchanges, which is what 1031 is, um, I break it down into really 4 or 5 different things. One, you have the traditional 1031, then you have a parking action or a parking transaction 1031. Then you can have a slow man's 1031. Then you have a 721 upreat. Then you have a DST. All are very beneficial to you if you know how to utilize them. So we'll just go down the list. A 1031 is a like kind exchange. You sell a piece of property and you don't take possession of the money. That money goes into a qualified intermediary who holds that money until within 45 days of the close of the asset you just sold. You have identified some properties. Now, you don't have to close on any of those properties, but that form does have to be provided to the IRS, and they have to know you are looking at other replacement properties. And it can be one property, it can be multiple properties. It really depends on what you're doing. You can go from short term to long term. You could go to short term or long term into self storage, oil and gas leases. There's so much out there for everybody. Trailer parks. I mean, there's everything. So within 180 days of your close and after your 45 days, which is within that 180 days, you have to close on the deal. Now, this can transverse years. So you can close on the deal that you sold the property in November, and then you can buy in, April of the next year or May of the next year, whatever your timelines are. So that's one of the benefits of the 1031. Now, there are other kinds of 1031s. There are parking transactions. You can go ahead and buy an asset, and the qualified intermediary holds title to that asset. And then when you sell your property, the money goes to the qualified intermediary and the exchange takes place and you get title to the property. That's called a parking transaction. And that happens a lot too, because sometimes those deals are just too good. You need to go ahead and pull the trigger, get it done. And, that's another way to utilize a 1031 exchange. A lot of people also call that a reverse 1031. Then you have the slow man's 1031. And let me explain the very critical nature of slow man. It has to be done in the same calendar year. So let's say you sell a property in January and you cannot find anything. You've tried to identify your qualified intermediary has held the funds for more than 180 days, and you're looking at paying capital gains and depreciation recapture on the sale of your asset. Well, if you can find a property within that year that is more than what your depreciation recapture would be and your capital gains, you can leverage up and still achieve the same benefits of a 1031. Now, on the back end, there are a lot of machinations going on. You've got to recapture the the depreciation, you do have capital gains, but then you execute a cost segregation study and you do it again, and that will offset your cap gains and your depreciation recapture. So that in essence, and you have to do it in a calendar year, that in essence is a slow man's 1031. It achieves the same benefits, but it gives you a whole year to do it, but you do have to scale up. So if you're not comfortable going a little bit higher in purchase price, then that may not be for you. Then after that, we have what is called a 721 UPREIT. Not a lot of people talk about these. These are when you're at the end of your property management life and you're like, I don't want to do this anymore. I'm out, but I don't want to have to recapture all this depreciation or all these capital gains that I've deferred for the last 20 years. So what do? Well, there is something called an umbrella partnership, and you would sell your assets to that umbrella partnership in exchange for shares. And then if you want to hold those shares, they will distribute dividends to you as long as you hold them, based upon what you contributed to that partnership on a pro rata basis. And then if you're ready to liquidate, you can exchange your shares into a publicly traded REIT. And then whatever you exchange for, there will be a capital gains triggered at that transfer, but it allows you to slowly bleed the capital gains into the market so you can take it in more bite-sized chunks, right? And then we have the Delaware Statutory Trust, which a lot of people love this. The only problem I have with the Delaware Statutory Trust for my clients is that they lose complete control. And, there's only so long that lasts. And then you need to figure out, what do I do next? Because if you put it into a DST for, say, 10 years and you're in year 11, what do you do next? Like, what do you do? So there's got to be a lot of planning around that. Otherwise, you're going to end up with a very large tax bill that you have no idea what to do with. So in the true vein of a typical real estate investor, I'm of the opinion, defer, die, and then pass along on a stepped up basis to my children. But those are in a nutshell, those are the things that people really need to pay attention to. So not only the rep status and the short-term rental loophole, but how to transfer these assets and get the benefit of it without getting, knocked on the chin with a big tax bill.
Yeah, it makes total sense. And I appreciate you breaking that down for our listening audience today, Brian. The next kind of question that I want to kind of ask you as we kind of near the end, is what future trends do you see, kind of at that intersection of real estate and tax law that investors should prepare for over the next few years, especially in the lens of a new administration?
I'm glad you asked that. I was talking to a law partner today at lunch, and we were like, he just got back from a conference in Tokyo, and we were talking about cross-border tax transactions and, how to, secure your assets, but also how do we deal with what's coming down the road with the new Trump administration. And quite frankly, if you're a real estate investor, here's what I'll tell you. You have every reason in the world to be excited. Interest rates are coming down. Bonus depreciation is most likely going back to 100%, which is phenomenal if you are a real estate investor, especially in the short-term market, but it still helps everywhere else too. And that's going to, cause a spur to the market to keep it going. I do think as real estate investors, we should really start looking at affordable housing. I don't think there's enough out there based upon the current market prices and the needs that we're seeing around the country. And I'm not here to stump for affordable housing, but I do know that there's a need for it, and it will pay you back in dividends. There's a great amount of money to be made there. And it's needed. These rent prices are getting out of control. We need to kind of pull that in. But from a tax perspective, we are going to see the opportunity zones, start phasing out. They phase out in 2027. I know that this administration that is coming into office is really big on real estate, and why wouldn't they be? He's a real estate developer. So benefits specifically targeted to real estate will be coming down the road. Benefits specifically targeted towards developers will be coming. We will see bonus depreciation go back to 100%. And we will probably see the capital gains rate come down a little bit. I tend to think he's going to want to cap gains at 15% and make that permanent. Now, and I know that the 2017 Tax Act is set to sunset at the end of 2026. So 2027, we would go back to pre-2017 rates and that tax code. I know that he is really pushing to extend everything in that 2017 Act. So as real estate investors, that should make you very happy because we know interest rates are starting to come down. We've already seen a 75% basis point cut. And we know that the market is starting to loosen up a little bit. Even the credit markets are starting to say, all right, I'll lend money now. And I think for real estate investors, that's a good thing for us. So I always tell people, look, the best time to get into real estate was 5 years ago, but get in now because the next 5 years is going to fly by and you don't want to miss out on it.
Yeah, I so appreciate that. And sometimes people just need to kind of get over that analysis paralysis and just get started and learn your way through the process. Obviously, there's plenty of people that you could identify as, good mentors to coach you through the process. And, one of the best ways that I personally have learned real estate is just by having earbuds in my ears for a few hours a week to kind of learn, what's next for the industry, just try to stay as much on the front lines, of the discussion as I can. So Brian, I really appreciate the time that you've given us today. What would be maybe one or two different ways that our listening audience can learn more about you and connect with you?
Sure. So I put out free content all the time on social media, on TikTok, on Instagram, on Facebook, and I even provide forms and a little bit of guidance on those platforms as well, even on YouTube. But if you want to talk to me, like you've got a legal question about a syndication deal or you need help with something, you can find me here. I'm at Thompson Burton in Franklin, Tennessee. We have a Nashville, Franklin, and Huntsville office, and we are real estate centric. We do all things real estate. So I'm here 60, 70 hours a week. So you know where I'll be. I'll be right here. So anyway, that's how they can reach out.
Yeah, great. Well, we'll definitely put those links in the show notes for the episode. And Brian, again, really appreciate you joining us today and the value that you've brought to our listeners.
All right. Thanks so much for having me. I do appreciate it.
You bet. And listening audience, thank you again for jumping into another episode of The Freedom Point. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.